special program. Today's program is an excellent program. As I said to you all before, this first session is very important. So many of you will be struggling with the option strategy, how to implement strategy, what is the best time to implement a strategy, what is the best process to implement the strategy. So we cannot make everything 100% error free, 100% loss proof, that we cannot make, but we can increase the chance of profitability if we will use little bit of study or little bit of complex study in the market. So I have simplified these things, and this time all the strategies whatever you are going to learn, it is with adjustment. So it is a 12 session, and each session is of 45 minutes to 1 hour, and 12 sessions. Today 9:30 to 10:15 is the English session, again 11:30 to 12:15 will be the Hindi session. So those who cannot understand English, they can join the Hindi session. And you are also allowed to join two sessions. So there is no restriction that those who joined English session, they cannot join the Hindi session. You can join both the sessions. So there is no restrictions on the sessions. So in both the sessions, you can join. Second thing is that all these strategies you are going to learn with adjustment. So how to form an adjustment, so what is adjustment, all these things you are going to learn, all these strategies with adjustment. So that's very important. It's on adjustment. There is no book available in the market on the subject of adjustment. It is very, you can say it is a very difficult subject of, you can say it's a very complex subject which doesn't figure in any of the books. So Smart Finance is a company which is established in the year of 2004-5, and our existence is from 2004 to 5, and we have innovated many concepts. So our innovations is from the year 2005 to till date. We have innovated many unique concepts like beta decoupling method, like Z-score method, like you can say in W.D. Gans concept, many methods. We have also introduced to the world how you can utilize the volatility, daily volatility in your trade practice, how you can utilize volatility along with your Fibonacci ratios, how you can utilize volatility with Elliott principles. So these are our unique research. Other than that, my own methods goes into a non-ending spiral. You can say those who know about that, they will be knowing, you can say a lot of things every year from the year 2005 to till date. Every year we come with 2 to 3 different methods. So this is about the Smart Finance and its research work, and I authored 6 books on the capital market, and all are ISBN protected books, and it is on unique concepts. And you can find my books on Google Books, you can find in Amazon, many places you can find it out. So you can say all this research what we have done, it is all are true research. So this is about the Smart Finance and its works. So more you can find
all of you with some beautiful music. First, I will start up with our national music, one of our national music called Vande Mataram. Second, I will make a song. It's a song which I've been learning for a few years. It is one of my great songs in Trinity College. So let's start.
I have told you about Smart Finance, about this program. It is a 12 session program. 2 sessions will be conducted every day, English and Hindi, 45 minute to 1 hour session, and all these topics whatever is listed you are going to learn along with a great great adjustment principles. Here I will not take you to the stops of option Greeks, make it complex, make it ambiguous, or make it difficult. So I will take you across the strategies how easily you can form. So if it is easy, if it is smooth, if it is, you can say, understandable, then many will start using it. If it is difficult, if it is complex, if it is ambiguous, many will not use it. So that is my objective here. So fine. So this is Ranjan again from Chennai. Smart Finance is a company established in Chennai, and here we are established from the year of 2005 to till date. I am the author of 6 books on the capital market, starting with the Master's Key to Futures and Options. This is my first book in the year of 2004, which is having a lakh plus buyers, and it is also I am the author of Gann's method, technical analysis, Fibonacci principles, and other things. Here, all these concepts, my concepts are mostly my new innovations. I do not copy anything from anywhere. I do not follow any principle which is non-mathematical. I do not accept any principle which has not a scale, which doesn't have a scale. So this is my method of following. So I do not publicize here how much I made the money in the market, or what is my contract note, what is my blah blah blah, all things. I do not show that. So those who know the smart finance for a long period of time, they knew I am a very active and aggressive trader, and I follow my own principle. So you can see that in my laptop there is no chart, graph, notes, softwares are there. You can see nothing except my softwares. Fine. All of you have been given an option testing tool. So this tool also is being given to all of you for a period of 3 months to use, and this is a great tool. You can backtest any option strategy. Fine. So we'll start the session of the day with very fundamental concepts, but very important concepts. We'll start the day with the mathematics of VIX, how VIX is important for you. We'll start the day what is the correct process of adjustment. Then tomorrow we'll be entering to the different subjects called vertical, horizontal, diagonal spreads, calendar spreads. So two subjects will be taken in every session. 12 subjects are there, 6 sessions, 6 in Hindi, 6 in English. You can join both. So now start with VIX, volatility index. I have given you in your group 2 PDFs. One is the volatility index white paper. It is a white paper released by the NSE. What is the computation method of this paper? Other things I have given. This says the complexity of this calculation. I will also say if there is a VIX for Nifty, why the same VIX is not there for Bank Nifty? Why the same VIX is not there for Fin Nifty? Why it is only for the Nifty? So this volatility white paper what NSE has given, this volatility white paper does not contain the term called Bank Nifty or Fin Nifty. Why it is for Nifty only? The computation takes a time parameter which is not suitable for the Bank Nifty, which is not suitable for the stocks. It takes 3 months options into account, and VIX is calculated from option data, not from the stock data. Also, VIX is being calculated based on the forward value of the index. So your Nifty, if it is in premium and discount, that also impact your VIX. So here, so next month you can say here near month and next month Nifty option contract, they have mentioned it very greatly. Whenever you find time, you can go through that. And this is the very complex formula for the VIX calculation. We'll not go into that, how we are going to utilize it, we'll be learning it. and when there is an absence of VIX. Bank Nifty doesn't have a VIX, stocks doesn't have a VIX, then how we can find out a VIX which is near similar, not exactly as VIX, near similar, 70% similarity of VIX. That process also I tell you. So you will be learning how to calculate the VIX of Bank Nifty and stocks in a near similar way, but it is not the exactly as VIX. That also you are going to learn. So coming with these things, this VIX is a very complex calculations as it is explained in the VIX white paper, as well as Chicago Board of Commodity Exchange is the innovator of this VIX. Volatility index presents the fear factor. It is a invention of Chicago Board of Commodity Exchange. Currently, it is a commodity exchange. It is known as a fear gas. It is known as a, you can say, it is a parameter which is required for your how much fluctuations it can give. How to calculate this VIX? So you have seen a white paper. So calculating in the for each weightage of every option we have to take. After taking the weightage of every option, there is a specific rule. So we have to combine all these things and find out. It is not the actual way. It is just a clone way or a simple way to compute the VIX. So this presentation also I have shared in the group. Once you go through that, you can understand. But what it gives you, that is more important. So do not go deep into the calculation of this particular VIX. When there is absence of VIX, any particular instrument, how we will calculate that I will tell you. However, this VIX has a great implication. You can say if I have taken from the January 2023 to the July 2023, as per my VIX estimation, how I estimated these price points also I am going to teach you. Don't worry about that. So this particular estimation happened. January VIX estimation said that 766 point of move will happen. 846 point move happened between the high and low difference. February it has estimated 847. It has 847 and it has gone to 879. March expected 650, gone 970. April expectations 627, 776 likewise. One thing it conveys to you very carefully. If you observe these two values, what actually happened between the high and low difference and what was the estimation of the VIX, you will find out that whatever the VIX estimation has given every month, the fluctuations, the oscillations, the high to low depth is 100% or more than that. So VIX has told you 650 point, you have achieved 971 point, but you have not achieved less. VIX has told you in the month of May 619 point, you achieved 620 points. July it has told you 640 points, you have achieved 756 point. So this is the high to low differences you have achieved. Question comes, how to catch these points or convert these oscillations to your profit? That is very important. It has happened. This high to low difference happened. No doubt about that. History says that. And one of our participants also sent me a record from the year 2022 till date. Santosh ji has sent me a record. Say he has told me that is from year 2020 it has happened everything, means the year 2020 onwards it has given all these things. You can say from year 2020 till date it has given whatever points he has estimated, he has got it. So that is the VIX principle. So it has a promise. Now think how we can convert it to a profit. Out of this 846 point, 760 point, any number of points, can I get at least 10% I can convert to a profit, 20% I can convert to a profit, 50% I can convert to a profit? Is there a, yes, there are ways to convert it. First go with the calculations. So here To start this, you have to understand 2-3 factors here. First day of the month. Keep a note if you have a pen and paper. First day of your month is important for you. First day of every settlement month is important for you. First day. So on first day, you need to take estimations of, based on the weeks, how much price fluctuations I'm expecting. What will be the probable highs and probable lows? That is what you have to identify first thing. So here, first day starts on, first day ends. You don't worry first day if it goes out of your hand. Second day you can enter a trade. So there is no hurry in entering the trade. It has enough time to enter the trade. So 3rd of July, the VIX, the volatility index of Nifty was 11.54 and Nifty closing was 19,322. It is Nifty spot closing. I'm not taking future because future will have the premium, discount, all those factors. So I'm taking the Nifty spot values. I'm also taking the closing VIX of that day. These two things you got. Now my calculation starts. So this VIX, what we are getting, it is in percentage terms, that is yearly terms. So this 11.54, try to understand this part. This 11.54 percentage of volatility associated with the Nifty for the coming 365 days starting from 3rd of July. This is what the literal meaning of this particular VIX. I need for entire 1 month. So what I have to do? It is in percentage. So it is multiplied with 100. So what I have to do? 11.54. First I have to divide it by square root of 365. This is to convert into the daily terms. So something is in yearly terms, we need into the monthly terms. So first we have to make it in daily terms, and this net result need to be multiplied with square root of 30. So I got the VIX for 1 month. VIX for 1 month. So this, if I can just do it in the Excel, how it will look like. So I'll be getting 11.54 divided by square root of 365. So always keep a pen and paper in hand so that it will be easy for you, into square root of 30. So we are telling to the system, so this is the VIX for the entire month, and we have closed at what price? 19,322. So this part, if all this result, whatever the VIX is coming, so if this part, so monthly VIX MV I am mentioning here, if this MV I am multiplying with the day's closing price, which is the 19,322, and dividing the entire result by 100, I will get the range for the entire month of July. So entire month of July, I will get the range. It has happened 11.54. I have not calculated. It has happened. This is the VIX, historic VIX data I have taken. Where to get historic VIX data? Just go for a web search. All of you are champion in searching the informations. So India VIX historic data, if you can go here, you will get here data. So this is every day, what is the open, high, low, and what price it is closing. So this is July, first day of July, 11.54. From here the 11.54 has come. Is it clear? So now 11.54 is a historic data, or it is a data of the closing value of the VIX on 3rd of July. What we are doing? We are calculating in the month of July how much points of oscillations the Nifty can give between its high and low. That is what we are calculating. So it can give more, means we are happy. If it is giving less, we will be little unhappy. But history says it has never given you less, it has given you more. So if you keep this monthly VIX multiplied with 19,322 divided by 100, if you can make, again I am repeating, this is Nifty spot value, not future value. Future will be always premium or discount. So this 3.36 I'm taking, multiplying it with 19,322 divided by 100. So you got a fantastic result here, 639 point. This is the result you got. So all of you have taken the note of this particular formula. So this is the 639 point of movement is going to happen on the month of July. This I am confirmed because history says whatever VIX related estimations we have done from the January to July, every month whatever VIX promised to give, it is giving, or it is giving more than that. So we are expecting this 639 point of oscillation also will happen. Now question comes, how much out of this 639 point we are going to convert it to a profit? That is our skill. There only our skill, patience, everything will be tested. So now, so this we have got it. After getting these things, what is the next job we have to do? We have to do the estimation of a top and a bottom. What will be the top and bottom based on this 639 points? So on the day of July 1st, July 3rd, we got 639 points. So we can add with the low. Low on that day is 19,234. I am adding. So I am subtracting from the high of that day 19,345. So this says if the 639 point of oscillations happen, so 100% retracement as per Fibonacci can give me 19,873 or 18,705. Anything can happen, because if this happens, then only this 639 point of a reward is confirmed. That is what you are getting on which day? First day of your settlement month. First day of your settlement month. This is what you are getting. Is it clear to all of you? And 639 points is going to happen in the Nifty in the month of July. 639 point, and the beginning day of July we have found it out that there is, in this month there is a scope of 639 point to move, and more than that it has moved, and it will move more than that, or exactly it will give you that. However, how it will move, that is very important. So it has, what are the probability? So we are on the first day, there is a high and there is a low. I told you this low will be the monthly low, and there will be no further low will be created. So straight away it will move 639 points. This is one probability. Second probability is there is a high in the first day, there is a high formed in the first day, and there is a straight away fall of 639 points. This is the second probability. So this is the first probability, and this is the second probability. So this can happen. Or what are the third probability? This is very important. Third probability is if there is a new high is being created. So here till the first day high is 19,345. If there is a new high is being created on the next day, then the 18,705 what we are expecting, it will never come. It will come less than that. So next day, because we have derived from 19,345, next day it is coming to 19,434. The high is from a new high is forming. That means third probability will be from the new high. Whenever there is a new high is formed, you can fall 639 points from the new high to cover off that volatility estimate. Or if there is a new low is being formed, on the very next day, then you will, from that new low you will climb 639 points to create a high which may much more lesser than 1983. So you have four probabilities. It is done in the next first day of your settlement month. Keep it in writing. keep it in your book. This estimation has to be done first day of the month. Why I can't do after 7 days? You do it, no problem. It is mathematics, it will not cry. You do it after 10 days also you can do. 2 days before the expiry also you can do. So while doing specific mathematics, we should have an objective. Why we are doing it? You can do after 10 days. If the market is not accepting your calculations, then what is the point of doing it? You cook for the 1,000 people. You do not invite anyone. And you said, I have given a grand feast of 1,000 people. I cooked, but I did not invite anything. Finally, I have given all 1,000 plates to the crows. So it is a grand feast. So for that, do not tweak the unexperimented things. So this is experimented, not in a day or two. When I say there is a true research happens, I am going to give you a way how you can able to catch out of 639.25%, 30%, 50%. You can catch during this entire program, not in the first day. I am going to give you a way. But if you say that no, after 10 days you do and show me, then I have no way. So I have no way. If you say you give me a way to capture 10% out of this in every day basis, I do not have that way. That's why I said try to accept on originality if you are serious in learning this concept. Do not bring your expectations into the actions. I expect on intraday, I expect on weekly, I expect on this, I expect on that, I expect all 3639 point. That your expectations, if you bring, what will happen? Nothing you'll learn. So this program of 99.99 rupees is an absolute wastage for you, and so that also no refund policy, you will get disappointed. So fine. So how? So here I told you 639 point of move will happen. There are 4 probable ways it can happen. 4 probable ways it can happen. First way, whatever the low formed on the day 1, from that low 639 point climbing will happen non-stop. From whatever the high happened on the day, 639 point of fall will happen non-stop, or there will be a new high will be forming. From there you will be climbing 639 points. So this, or from there you will be falling 639 points. So this low will never happen. A new low will be formed. From there if you are climbing, so this high also will never happen. So these are the 4 probable actions possible with this data. With this 639 point to score, there are 4 ways it can go. So now you got a idea, very great idea you got. I want to catch a thief. The thief can travel in these 4 ways. If I block this all 4 ways, my chances of capturing the thief is 99%. Isn't it? If you get 4 different ways it is going to happen, 4 different ways it is going to behave, then if you block all these 4 different ways, then the capturing of that thief is more 99%. This 4 probability concentrate on this. 4 probabilities concentrate on this. These 4 probabilities are your success to option trade. These 4 probabilities are the only success to your option trade. You wonder n number of ways. This is only success to your trade. 4 probabilities. This price range, it's you have calculated. One high and one low has formed in the first day. If there is a new low happens on the second day, then the expected this high will never happen. If there is a new high happened on the next day, then this expected low is never going to happen. So what is the take? Can anyone tell me a secret how I can calculate? calculate these four ways I told you, four probabilities. If there is a straight away this thing happened, then it is, you can say there is no new, there is, you can say this low is the monthly low, so no further low is happening, I can be confirmed. If there is this high is the only high, then I will be confirmed. What I should, what is the, Sabir ji has given me one great answer. Next day, if there is a new high is happening, Sabir ji has given a great answer here. Sabir ji is telling that if next day a new high is happening, then 18,705 is a remote possibility. It is not going to happen. So he is going to form a sell trade at 18,700 put, which is not going to happen, and it is going to give him a great success. Jaswant, so here Vijay ji is telling that to short strangle to form, we can form a short strangle to benefit from that. So these are the, see, those who have understood these four probabilities, they are coming with the idea how to make money out of that. Fine. So all your ideas can be refined, but something it is very good to listen that, yes, you got an idea where to form a short strangle, where to form a short straddle. So this idea has come. Now we refine it. Now we'll go with this specific estimations with a specific small refinement. What we want to know? We want to catch a consolidation trend. We want to catch a bull trend and bear trend mathematically using this VIX estimation. So we'll be taking the help of the Fibonacci 0.2362 that sets up uptrend 0.382 on estimates down moves sets the downtrend, 0.5 retracement sets the range bound trend. So but here all this is your expectation, the you will not know which trend is going to catch. That is very important. All these things is our estimation. So that's why always I used to say, do not go by your wish list, you go by market's wish list. All the old participants, what I used to tell every time, your wish lists are long, but market is not going to fulfill all your wish. Market has a hidden wish, and that is going to be fulfilled, not your wish. You can dream anything. Market what gives, it is supreme. What it gives, you have to accept. The way we can think many things, we can become billionaire, billionaire, whatever maybe. If God wants you to be a beggar, you have to be a beggar. None of your concept will work. So that is why. So we propose and God dispose. So we expect, market gives. So our expectation is too much, it will give you peanut. You do not expect anything from your from the market will give you abundant. Abundant. Keep these things in mind. If you do not expect anything from the market, market will give you abundant resource, abundant money, because you do not have expectations. Once you do not have expectation, your full concentration on risk management. Once you manage your risk well, market will give. It has a potentiality to give. It has given. VIX related estimation is a proof of that. You estimated it will give only 639 points, it has given 760 points. You expected 766, it has given 846. You expected 650, it has given 970. More it has given. None of the month it has given less. That much or more than that. So our jobs, our focus should be how much we can capitalize on that. Next comes how we can identify this bull trend, bear trend mathematically using the VIX. Don't go by these numbers, come by these price points. So first day of the month, you estimated there are, you estimated in the first day of the month, you have estimated 639 point of move is going to happen. So the moment 244 point of plus or minus happen, it sets the trend. If there is a 244 point of move happen, then you can say that remaining price move also will happen in the upward direction, because Fibonacci trend set has taken into effect. 0.236 point of sets the trend, 0.382 confirms the trend, 244 point of plus move sets your trend. So you have plus 244 point of move happen post 3rd July. Carefully listen to this. For July, our estimation is 639 point plus 244 point move happened post 3rd July. Any day, may happen in a single day, may happen in 2 days. If it move from the 244 points from the low of the 1st July, in fact, very clearly we can say 1st July low from here, if it move plus 244 point, or in future any low has happened, whatever the period's low, you can say period's low, from that low 244 point plus happened, it sets the uptrend and it will complete 639 points. 100% it will complete. Why it will complete 100%? Why not 50-60%? Because historically whatever the volatility estimation given, it has awarded that. You must ask me one question, nobody has asked me that. How confidently I am telling that this VIX estimation is giving 100%, whatever is expecting it is given and more than how it is given, none of the technical indicator given this. Why? What is the point? The reason is VIX is calculated from the forward option data. VIX, the volatility what you are seeing, it is the volatility which is going to be there for the coming 30 days period. Coming 30 days period, it is going to be there. So that is what the VIX says. It is a forward indicator. It is a forward estimation. So it will get adjusted. It is not the. So here August also I'll forecast post Monday. Then next session onwards you will get a chance to follow. Till 13th of August session is there. So I'll make you to accept that yes, this works. This works. That time session will not be there. That time you will ask me to repeat, I will not repeat. So that's why my appeal, request to all of you with my folded hands, please at least 45 minutes think on this subject. Think on this subject. There is a VIX estimation 639 points. There is a Fibonacci estimation 244 points. There are 4 probability of movement can be awarded by 639 points. 639 points can straight away go from the first day's low plus 639 point. From the first day's high, it can fall by 639 points. Third probability, on the second day, if a new high is being formed to cover 639 point, from this new high it can fall by 639 point. If any new high is being formed post first day of our calculation, new low is being formed, so from there 639 points. So first day is top and bottom what we have estimated, it may prove true, it may prove or it may change over the course of time. So this is what I have conveyed to you. 2 plus 244 points Fibonacci estimation will give you, forget about these pricings from any low, any period of low, if 2 plus 244, after 7 days you are seeing, on the 7 days what is the low. So from that 7 days low, if market has gone up by 244, you will say that I am bullish in the market, and remaining points, you can say 400 points I am going to get. If in a period of time, whatever the high is there, from there, if 244 point correction happened, then you will say trend is down. It is going to give you another 400 point or more than that. That is what we want. That is what we want. It is a 19873, 1870, 705. is just a estimation based on the first day, just a estimation on the first day. If next day it is changing to, the high is changed, what next day it has changed? 19434. So what will happen? So now my fourth probability will come into action. So 944 minus 639. So its expected low is now 18794. So 705 will never come. 795 may come. 18795 may come. So same process, each time high forms, this low will become obsolete. This low will become invalid, but this invalid nature gives you an opportunity to trade. That is your catch point, that you need to say. If now I say that new high is happened, 705 is a remote possibility, it is not going to happen. I can form a credit calendar here, I can sell 18,700 put here, I can do anything. Many option strategies I can form along with that. This decision process is crucial. That is what I want to tell. Now, consolidations, bull and bear, these three things are three opportunities in market. As a option strategy trader, what you have to think? Bull trend, bear trend, consolidation are three opportunities in the market. I have to convert this opportunity towards my benefit. That is what your thinking should be. So these opportunities I have to convert into my benefit. How I am going to convert it? If I understand the concepts thoroughly. Fine. So this is what happened in the first, you can say 0.236 and 382 Fibonacci gives you a guiding post. Now, going to the next very important part of your conceptual discussions. These are the conceptual discussions. What is adjustment? Adjustment is a modifications made to an existing option position in response to change in market condition. Modification you made to the option position, sorry, your plan in response to the market condition. So this market condition is a changing thing, it can change. What kind of the changes market can give you after you initiate a position or after you initiate a option strategy? What are the changes or conditions can adversely impact you or successfully impact you? Change in market conditions involves different circumstances. Your volatility condition can change. You can change the position, rolling the position from one to other. That is also a part of adjustment. There are losses. You want to protect the loss there. You don't want the losses to go uncontrolled. That is one of the things. Profit taking, if sometimes profit is there, you want to cap the profit and expect the more profit to come. That is also a part of adjustment. Risk management, sometimes you form a strategy with 90% risk, means 90% of your capital is protected, 10 is not protected. After a day you are thinking that no, I should reduce my capital risk by some more points. You can reduce your delta to certain extent. Sometimes you said that it is too low volatility, so there is no point in managing theta, but after a day you are thinking that theta I need to manage. So these are the risk management. So these 6 heads you can form adjustment. So you can say that Mahabre Bap, 6 heads you have given for forming an adjustment, too difficult to make money. So these are the 6 situations compel you for the adjustment, but I will give you some simple ways. Now, adjustment can happen in 2 different ways: pre-adjustment and post-adjustment. What is a pre-adjustment? With the strategy itself you initiate an adjustment. Means whatever the adversity in that strategy, or whatever the risk in that strategy, you adjust along with the strategy. So you can say that, okay, I have taken this. So let me adjust. So what is that? For example, say 3rd August, 3rd August, I want to form a simple bull call spread. So Nifty has fallen 2-3 days. So somebody told me, my friend told, my broker told, my relations told. So they said, Ranjan, you buy 19,600 call and sell 19,700 call. So they told me this. So I said that, okay, my broker, my friend, my relations, they said, you buy it at 124, you sell it at 70. So, or 120, 70. So you can say that I did a risk reward analysis like all other people are doing. So 7, so 7, 3, 10, so 5. So I'm saying that 50 rupees risk, 50 rupees reward. If by 3rd August Nifty never come above 19,600, my loss is 50. And if it is going above 19,700, then my profit is 50. So I am in 50-50 Britannia biscuit. So now 50-50 biscuits, all of you would have seen that 50-50 risk reward. So what I have to do now? Now I have to mitigate that risk. No. You are my friend, you are my relation. It is, everything is okay. Your advice is highly acceptable, but this 50 rupees risk I don't want to take. I want to reduce it. Reduce it. How I can reduce? So I can say that, okay, this 50 is not acceptable to me, but the reward 50 will come only when if it is going above 19,700. So I am forming a credit spread here. 19,800 call option, say I am selling at 30, and I am selling, buying a 19,900 call at 9 rupees. Plus 9 minus 30. So here what happens? This is a pre-adjustment. So here, this is my original strategy where I am expecting 50-50. But also I am taking a credit call spread. This is just an example. Don't think that, no, this is the strategy and this is the golden rule I got. Tomorrow I have to jump it. No. So 19,800 call sell and I am getting back some 21 rupees. So my 50 rupees risk I am reducing by 21 and it is making to 9. 4 to us 29 rupees I am reducing. This process of combining a credit spread with a debit spread or combining a debit call spread with a credit call spread is known as pre-adjustment. Simultaneously, it is being taken. This process is known as your pre-adjustment. Now, second process we have post-adjustment. Once we initiate a strategy, market condition changed, risk management needs arise. So that time we are going for a adjustment. Means, okay, same example you can say I have initiated 19,600 call, I bought 120 and also I sold, this one is at 60 or 70, whatever may be 19,700 call. So tomorrow I am watching that, okay, I have come above this 19,700, but I am making only 20 rupees out of 50 rupees, only 20 rupees I am making. 30 rupees has not yet come. So I want this 20 rupees should not go out of my hand and another 30 also should come. So say Nifty is at 19,750 at that point of time. So my objective is to protect this 20 rupees realized gain and also wait for the remaining 30 rupees to come. So in that case, I can go for a credit spread that time at 19,900 call. I can sell along with 950 call I should buy, and it should have a technical backing. Why I am doing this adjustment? It must have a technical backing. So first I have told you, with the adjustment you take it, you reduce your risk. Second, I told you this position went into profit, you want the profit should not slip out of your hand, and same time you want to protect it. So this is also a second adjustment you made. So first adjustment was pre-adjustment along with the strategy, keep it in writing. Adjustment made with the strategy is pre-adjustment. Adjustment made post you initiate the strategy based on the market condition. risk mitigation process, based on your profit and loss to realize. So all these things which you have implemented in a staged manner post you initiate the strategy is known as your post adjustment. So you have learned VIX. VIX is a complex mathematics. Then you have learned how the VIX is calculated. VIX is calculated based on a simple, you can say it is in a complex math. I have given a write up here how through options you can able to calculate. Second, I told you VIX, what benefit it gives. Then question comes, if I do not have a VIX, what I should do? Bank Nifty doesn't have a VIX. Stocks doesn't have a VIX. Then what I should do? There I cannot get the VIX into action. However, I can do a small mathematical work and to get those VIX, those clonical VIX equal to the, you can say just near to the VIX. Some calculations we can do to get it. So that I will share you with on Excel on Monday. Participant, he has sent on record VIX from 2020 to 2023, 2020 से लेके 2023 तक, 2020 to 2023, whatever first day's VIX, first day's Nifty spot closing, monthly high, monthly low, price difference he has taken. So expected क्या था, expected क्या था, actual मिला कितना. देखिए 2020 से लेके अभी तक till from 2022 till July 2023, whatever VIX has promised, it has given you more than that. So now question comes, if you understand the four probabilistic action what I have told you, if you understand the four probabilistic action what I have told you, if you have understood how the Fibonacci ratio is going to help you to identify the direction of the movement, price direction or the price direction of the movement, and if you understand the four probabilistic estimation of the movement, you can form wonderful strategy. You don't need to learn any more strategy if you understand these two things. So whatever VIX has promised, it has given. So we can now do wonderful strategy out of this. Do not go deep into this example. It is just to understand what is VIX, how VIX we can calculate. VIX calculation is again a complex process that I have shown you, Saraji, in the white paper. However, certain things like Bank Nifty, we do not have a VIX. Stocks, we do not have a VIX. How to calculate that VIX? I will formulate a Excel sheet and give you in the next session. Next session, I will formulate a Excel sheet. It is just for understanding, and I have clearly mentioned this is not the actual exact way. It is just to understand how we can calculate the VIX. But I will give you a detailed, more accurate way to use the VIX on the next class. You are going to get more. So you have to, when you form a strategy with adjustment, it should be protected. So your interest should be protected. That is what you are going to learn in different quote. Whatever VIX promises in a month, it gives that much of price oscillations in that month, unquote. So here I did not repeat or say any sentence that first day's VIX should be maintained throughout the month. No, it can change. What I have told, based on the first day's VIX, whatever the expectations or the estimations you have made on that month, VIX, that estimated price oscillations has happened. It is a true from the year 2022, 2023 now or much before that. That is what I have said. VIX can change next day, next hour, or it can behave reduce also next hour. So strategies are important. What strategy we are going to take? So we have not started learning the strategy.